Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 38, we're going to talk about reporting gain on the sale of a residence. So anybody who sells a house potentially will have gain on that sale if the ultimate sale price is greater than the amount they purchased that house for and the amount they've put into that house in terms of improvements. We're also going to look at how Code Section 121 can affect this gain because there's a certain exclusion that you can get against the gain on a sale of a residence as long as certain requirements are met. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, before we can really talk about gain and reporting it, we have to look at the exclusion of gain on the sale of a residence. So, as I mentioned, if your amount realized on a sale, the sale price exceeds your basis in the residence, which is generally your original purchase price, then you're going to have gain that's reported for income tax purposes. However, there is an exclusion for some or all of that gain. If there's an individual who owns and uses the residence as a principal residence for 2 of the 5 years leading up to the sale, and that individual sells their house, then they can exclude up to $250,000 of the gain if they're a single filer, or up to $500,000 if they're filing a joint return with a spouse. And even if you can't meet this 2 of 5 year ownership requirement, there may be certain exceptions which allow you to at least get a partial exclusion for things like changes in health or moves related to jobs or even maybe the death of a spouse. Now we'll get into that another time and won't dive into those details, but it's also important to note that you can only use this exclusion once every 2 years as well. So, when it comes to tax reporting, the big question is, do you need to report gain? And I'm going to kind of follow this slide backwards and mention the big surprise out of the gate, and that's that if you have gain that is less than the amount of your exclusion, then you don't have to actually report any of that gain unless a 1099-S was issued to you in the transaction where you sold your house. But that jumps us back up to the top where we mentioned, do you need to report gain? And the answer is yes, if, as I mentioned, your gain is greater than the exclusion available, or if you're issued a Form 1099-S, or the third point is mentioned in the IRS publication, but you don't need to worry about this as much. That's if you actually want to report the gain as taxable, for example, you might want to do so if you plan to sell the new house within 2 years, so as to avoid the 2-year period that has to elapse between successive sales of residences. Now, if you do need to report gain, then the following forms are going to apply. You're pretty much always going to have to do Form 8949, and whatever's on the 8949 is going to have to be rolled onto Schedule D of your Form 1040. Now, this is the relevant portion of Form 8949. You're pretty much always going to be in the long-term transaction portion of the form, which is part 2. And as we're going to see, jumping up to the next slide, you'll generally have to check box F for no 1099-B issued, which you'll see here in the middle of the page. And then you'll report the transaction here on a line of this 8949 part 2. Now, it's important to note that in column F, you'll include the code of H, and then you'll include the excluded gain as a negative number in parentheses in column G. Now, I've mentioned that the gain is up, or the gain excluded is up to $250,000 or $500,000, but your gain that you exclude cannot exceed the actual gain realized. So, in this case, we have, gain or loss that might be less than the actual exclusion amount, and if so, you have to report the lesser of the exclusion or the actual gain. So for example, if your gain on the sale of home was only $190,000, the number in the column G couldn't exceed negative $190,000. And then this would be rolled onto Form 1040 Schedule D, where form or transactions from 8949 where box F was checked will be reported on line 10. And you'll follow a lot of the same procedures, except there's no code to enter here, but in column G of Schedule D, you will include the excluded gain in parentheses as reported on column G of Form 8949. You can see that column G here, adjustments to gain or loss. Now, some other important points to remember is that there's a use requirement of 2 of 5 years that has to be met here. So only an individual is eligible for this gain exclusion. Now, if the actual owner of the house was a grantor trust or a single member disregarded LLC, keep in mind that both those tax statuses would treat the individual as the owner of the house for income tax purposes. So in those cases, you could qualify for the exclusion, but usually entities that own a residence won't qualify for this gain exclusion. So that's an important point to note too when you're planning, that you can lose this exclusion if, for example, you transfer your residence to a multi-member entity or to a corporation or to a non-grantor trust. There's also some special rules that can apply when the owner dies, but keep in mind there will be a step up in basis to remember. Now, if you need additional resources or guidance, pretty much everything in this presentation is taken from IRS Publication 523 titled Selling Your Home. Thank you for listening to this episode of the 10th of an Hour. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thanks again for listening, and I look forward to seeing you in the next episode.